Welcome to another lecture. Welcome to another class in personal finance. I'm Jim Munchback. We're about to get started, going live on Facebook and YouTube, getting things started this morning. It is 18 October, year of our Lord 2022. And today, in this autumn cool day in Houston, we're going to talk about investment strategies. So let me jump on over to the Zoom meeting and let the students in. If you're joining us on Facebook or YouTube, you're welcome to leave a comment. Let me know you're watching. If you're a student at the University of Houston at the Bauer College of Business, it would be helpful if you put in a comment. Just let me know what time you tuned in, what time you're watching this live on Facebook or YouTube. Okay, so I'm going to jump on over to the Zoom meeting now. The meeting has begun, and I'm going to let some folks in and see if we have sound. Let me get my screens all cleaned up. Okay. Welcome aboard. If you're joining us in the Zoom room, welcome. For students who are joining in the Zoom room, I see you're muted, which is okay. If you could, though, if someone could unmute yourself and just let me know if you can hear me. As usual, it's always a good idea to check the audio. Awesome. Thank you very much. I appreciate it. Good to see you guys. It's a cool morning in Houston, like the coolest morning of the year since the springtime. I kind of like the cool weather. So if you could go ahead and just pop in a comment, let me know you're here so I can save the chat. Thanks, David. I hear you. You hear me. We hear each other. Actually, I read you. So today we're going to talk about investment strategies. We'll get started in a few minutes. We're actually early. It's still a couple of minutes before 10 a.m. So I'm sure we will have several students join us. If you're here early and you have a question or you want to talk about an assignment or anything at all, it's your time. I'm happy to answer any questions you have or have a chat about anything you'd like to chat about. This is your time. We're early, so if you don't say something, then I typically just ramble for a few minutes. We won't officially get started until 5 minutes after 10. That's when we will stop letting students come into the Zoom room. We'll just require that you watch this on YouTube or Facebook. This is being streamed live to Facebook and YouTube, so if you don't know by now, we do have a YouTube playlist. I'm not going to show you that right now, but it's right there. If I click on it, though, it'll take me to YouTube, where I would have to jump into the playlist. But you have a link to the playlist in Money Study Group. Okay, so I made a couple changes to Missional Money. You may have noticed I use Missional Money. That's kind of my main website. My company website is Bayrock Financial. Money Study Group is where we have the online content for the course. So I made a few changes to Missional Money. Whenever I post something at Missional Money, I post it under the category of assignment. So if you're a student, whether you're a student at the University of Houston or you're just participating in one of my online courses that are basically for education and training for financial planning, either way, missionalmoney.com is really my main website. It's where I post most of my content. And so for you students at the University of Houston, I wanted you to see that I did add this, I added the logo for Money Study Group, and that will just take you right to Money Study Group. So that's just for your benefit. And again, this is really a template designed only for the category of assignment. So that's everything you would need. But I also added this search bar, which is kind of cool. I should have done this a long time ago, but anyway, this took a little work. So when I hit insurance, I'm going to just do that for fun. it will hopefully take us to, it takes us to a search page here. Let me see if I can expand that. So that's new. That's new on the website on Missional Money. So now you can see there's lots and lots of posts that have the word insurance. Some of them, many of them are in the category of assignment. You can see the categories there as well. So kind of a cool deal. But one post that I added this week for your benefit is this one, adding home and auto insurance to your plan. And I'm going to spend a few minutes talking about that this morning just as a review for last week's assignment. But then we're going to jump right on into investing. If I can, let me see if I can get there. Yeah, so there we go. So this is what we're going to talk about today when we get started. Looks like we have some students waiting to be admitted. So I'm going to check to see if there's any questions posted in the chat. It looks like you guys are just waiting. And that's what we're doing. We're kind of waiting for that magic moment, 10:05, when we'll actually get started. But I think what I'll do is, well, it's 10:02. So I'm going to go ahead and do this review for the home and auto insurance. Actually, I think what I'll do is, that looks like it's not in the right category, which means it's a different template. Sorry about that. I want to, here we go, adding home insurance. So I want to do a quick review. You should have seen this in Money Study Group. So I did post this in Money Study Group. And if you turned in your assignment already for the Insurance 101, most of you did a great job. I mean, the assignment was really pretty straightforward. What I asked you to do was get a quote for your car insurance. And in the meantime, I gave you some homework to do some research to understand the coverages that are involved in both your home and your auto. And most of you reflected, when you did the assignment, you were supposed to write an article and tell me how your coverages in the car that you're going to buy, in the home that you're going to buy, in your kind of make-believe plan. You told me in the article what coverages you would put in on your car insurance and why. And that was the goal of the assignment, was for you to go and do an auto insurance quote, and in that way, in that process, learn how those coverages work and how much those coverages cost relative to your policy. So what I found is, and if you got full points on this, either that basically means I didn't find any big mistakes in your assignment. But if you got any deductions, even if it's in the queue, like there's a lot of assignments that are still in the queue that came in last night and yesterday that I have not yet graded. So if you've already turned your assignment in early and received 60 points because you turned it in early by Friday at 3 p.m. or shortly thereafter, then you don't need to pay attention to what I'm about to say. You might want to pay attention just to kind of support your learning, but you demonstrated to me that you get it. You completed the assignment well. When you added your home and your auto to your financial plan, you completed those data cards completely and accurately, at least enough to make me believe that you understand the idea of the coverages that you selected and how you're going to reflect those coverages in your financial plan. Some of you got deductions. Some of you will get deductions because I have not yet graded your assignment. You need to pay attention to what I'm about to say. So what I have here is a couple of data cards that I just grabbed from students. I tried to gray out your names so you can't see it, but this is a data card, auto insurance data card. As you can see there, you should be very familiar with this. But this is just one that raises a red flag and causes me to stop the assignment review and just go ahead and give you a deduction. So if you turned in your screenshot from your auto insurance and it was missing these check marks, like you did not check comprehensive or collision, or you had a zero deductible, I mean, basically that means you added the data card, but you didn't pay any attention to the data fields inside that data card, which means your data card is incomplete, inaccurate, and you got deductions, or you will get deductions. So again, those of you who didn't get any deductions, you paid attention to these little bitty fields and you clicked on the right ones. Bottom line here, just in case you didn't know this, if you purchase a car with a loan, which is what your assignment was last week, you were supposed to go and purchase a car, a home, and put some debt on a credit card. And remember, I had you do that because I wanted you to do the Credit Crush assignment where you would get to see the different strategies for paying off credit. So if you did the assignment, you got to see how that worked. But if you did not create those credit card, the credit card, the auto loan, and the home loan, then you didn't get that assignment. And you're going to need to do that because it's a big part of the capstone. But in this week's assignment, you were just supposed to add the insurance. Well, think about this for a minute. If you already have a loan for the car because you picked your dream car and you went out and you did the research to figure out what kind of home you could afford and you got the home mortgage and that's all in your plan, well, now you're adding the insurance, okay? So if you're adding insurance to your financial plan for an automobile that you have a loan on and you checked that you don't have comprehensive or you don't have collision, well, that's not good. That's not accurate. That's incomplete. That shows me that you're missing something, because if you have a loan on your car, your insurance company is going to require that you have comprehensive and collision. Think about it for a minute. If you borrow money from me, say you borrow $25,000 from me to go out and buy a Camry, a 2021 Camry, I'm going to require that you have insurance on that car if I'm loaning you the money, because if you wreck that car or it gets destroyed in a hurricane, either way, I want to make sure I get paid. So two things happen when I lend you the money for that vehicle. Number one is I put my name on the title. You don't actually own the car. You and I own the car. Mostly I own the car because you owe me money for the car. I lent you the money. You have a loan on that vehicle. The second thing that happens is I require that you have insurance, and you have to prove to me that you have insurance, and that's why I'm on your title and I'm also on your insurance, because if you don't pay your premium, your insurance company is going to notify me, and I'm either going to call the loan or I'm going to make life difficult for you. That's how it works. So therefore, if you don't have these checked, that tells me you just weren't paying attention. So if you get deductions on this assignment, it's too late to fix that. It's in the can. When I grade those, you will get those deductions. If you turned it in early and you got pushback and you corrected it and turned it in on time, then you will get full points and you'll get the extra points. So again, you turn in your assignments in early, and that puts the ball in my court to give you some feedback and gives you the opportunity to make corrections. As long as you make those corrections by the due date, you get the extra points. But another big thing that I wanted to mention in this post is what I mentioned, is that if you got deductions on this assignment, you can live with that. Trust me, that's not going to affect your grade significantly. But what you don't want to do is you don't want to just blow by this assignment and then not go back and make adjustments to your plan. Excuse me. In other words, If you just see this and you go, oh, I got some deductions, and then you do your capstone assignment and you submit your capstone assignment without correcting this, you will get more deductions on your capstone assignment. So that's the auto card. This is the homeowner's card. This is your homeowner's insurance. And I got this from several students where clearly you were not setting up this homeowner's insurance correctly. So in this case, it says this student said they had $3,689 of coverage on their home. Think about that. If that's you, if that's your home, and you have coverage in the amount of $3,689, that means your home is insured for $3,689. And that's not much of a home. And then you look at the annual premium, which is $1,440, and you can obviously see that's a mistake. And that's what I saw when I see that. So I'm not going to give you I'm telling you now, you need to fix that. You need to think about, what is this card, this data card about, homeowner's insurance. Spend a minute, look at it, think about it, and then make corrections. So I wanted to spend a few minutes and just review that. There is a post, again. I even did a video. You can go back and watch that. But if you have any questions about that, speak now or forever hold your peace. I'm going to jump into the assignment now. So it's time to jump into investments. We could have spent a lot of time on insurance. I like insurance. I know a ton about insurance. And as many of you commented last week, you see that there's a lot to learn about insurance that you didn't know. And my hope is that this last week, you spent enough time in insurance to know that those coverages are key. And as you get quotes for your insurance, not just in your assignment last week, but more importantly, as you move forward in your life. Sorry, I have hay fever or something like it. It started in my head and now it's in my chest and my throat's tickling, and I'm going to try to make it through this lesson. If I don't make it through the lesson, though, I will post a previous lecture where I teach these same concepts. Today I'm going to talk about 4 investment strategies designed to maximize returns and minimize risk. And I'm going to cover the perfect investment. But what I was saying is that insurance is one of those topics that we could spend a long time on. And I would love to do that, but that's a whole nother semester. It's a whole nother course. And so my hope is that what you learned this week in doing an insurance quote, you take that and you build on that for the rest of your life, because that's really the best way to become an informed consumer about insurance, is to do reviews of your insurance and get quotes on a regular basis. So on your home and your auto, that's a great place to start. Do comparison shopping. And as you do that, you're going to learn more and more about it. And you can always reach out to me when the time comes and you're getting that quote and you have questions and you want to know how it works. And come back to Missional Money and just hit that search button and search insurance, and you'll find I'm constantly adding content to the website, and that will become podcast episodes and part of online courses that you will qualify for. In other words, because you're in this course, I'm going to make my courses available to you like for life. So I'm hoping that helps. And I'm hoping that we can continue the learning even after the semester's over. So with that, let's jump into the most popular topic of the entire course. And again, just like insurance, I'm not here to make you an expert on investing. I can't do that. But I promise you, if you pay attention to what I share with you over the next few minutes and over the next couple of weeks, if you pay attention and you just let it sink in, you will learn about investing in a way that will prepare you to do the things you need to do to build wealth. And so I'm going to share 4 investment strategies today, if my voice will last. And I've taught this many, many times. So, like I said, if I have to stop halfway through, you'll be able to pick up another lecture. But I'm going to talk about 4 investment strategies and also the perfect investment. So, the 4 investment strategies are listed there, and they're very simple. You can Google them and get tons of information about them. They're very basic, but they're very powerful, these 4 investment strategies. And that's what we're going to talk about. And I always like to say, and I say it over and over, is that these 4 investment strategies are really specifically designed to help you maximize returns and minimize risk over time. So if you just let these sink in and become familiar with these terms, their investment strategies are really terms: diversification, asset allocation, dollar cost averaging, and portfolio rebalancing. Now, if you're an experienced investor and you're watching this on YouTube or Facebook or listening in a podcast episode, you know those are basic. Everybody should know these strategies. But if you're a student and you're getting started, then they may be new to you. But there's tons of information out there about how these strategies work, and they're not mysterious. They're very simple. They're very straightforward. And I promise you, what most people don't know is how powerful these strategies are in terms of building a financial plan. I learned about these strategies at a whole different level once I became a financial planner. Actually, I was a certified financial planner and a State Farm agent at the same time. And I started working with clients, doing financial planning reviews. And one day this guy came into my office, and I tried to tell this story every semester, but his name was JD. JD and I were coaches, little league coaches. Our boys played baseball together, and it was a ton of fun. He was a great guy. He lived in a small house just like I did, drove an old used car just like I did. I was a State Farm agent, and I was still living in a small house. Well, a relatively small house. But anyway, JD shows up in my office, and he said, Jim, I wanted to get a second opinion. I see you do financial planning. So he asked me to do a review of his finances. And I did that. And when he laid down his statements, his all of his information, I started looking at it, and I was like, dude, how did you get, you're a millionaire. Like, you've saved so much money. How did you do that? Like, I was shocked because I don't know if I mentioned before, I was a State Farm agent in Clear Lake. And if you saw where my office is, you would see that it's right smack dab in the middle of a lot of very wealthy looking people. I mean, houses that are $1 million plus houses, Bay Oaks Country Club. It's a very affluent neighborhood with very high cost vehicles and houses, and people looked like they were rich, but they weren't. And I started to discover that most people were living paycheck to paycheck, and they had all these bills, and they had, the bank owned the house, the bank owned the cars. But when JD came in, it was the other way around. He had no debt, and he had saved a significant amount of money. And I was just so curious about how he did it, and he told me how he did it. And it turns out these 4 investment strategies are exactly how he did it, starting with the perfect investment. And so let me tell you about the perfect investment, and then I'll jump into the 4 investment strategies. So what do you think of when I say the perfect investment? Naturally, as a fiduciary financial advisor, as an investment advisor, as a certified financial planner, if somebody told one of my clients they had the perfect investment, I would just kind of smile and say, yeah, right. And so you should always say that too. Yeah, right. So how can I then turn around and teach you about the perfect investment? What do you think that is? Do you think there really is a perfect investment out there? I'm going to give you a minute to see if there's any suggestions in the comments. If you're watching on Facebook and YouTube, or YouTube, hopefully not both at the same time, I want you to think about that question. What do you think when I say, I'm going to tell you about the perfect investment? Do you think there is one? Does that make you skeptical? Is it possible that I might have something to share that would be worth listening to when I say, I'm going to tell you about the perfect investment? So I see no comments from my students in the Zoom room. So Alyssa, that's a good one. The highest return while minimizing the risk. That's a pretty good answer. That's not exactly what I'm going to tell you about when I tell you about the perfect investment, but that's a really good answer. In fact, I would say that these strategies that I'm going to teach you, combine them together and put them into a plan, and you will have the perfect investment plan for you, for a young person who's got a long time horizon in front of you for investing. These strategies are specifically designed for you to help you do exactly that, Elisa, to maximize returns and minimize risk. But the perfect investment is a little bit more specific. So anyone else? No one else. Just Lisa. That's just kind of heartbreaking that there's no one out there willing to take the risk to say, here's what I think the perfect, or even here's what I'm thinking when you say it. So I guess we'll just move on. And I'm wondering if you guys are doing what these guys are doing. You see this is the professor here. All of these images, by the way, in this post are in my book, Make Your Money Count. I hired a young man, a friend of mine, to do these illustrations, and we got a big kick out of this guy. He named him. I didn't name this guy, Professor Poop. That's what he named him. So it's a strange name for a professor. But the truth is, my friend who did these illustrations, this young man, his name is Taylor Springle. Hey, Taylor, if you're watching. So when he did this one, the point was, this is boring stuff. Investing and the technical stuff related to investing, it's boring. And most people, if you're me and you're doing investment advice and you're meeting with people, it's a very common occurrence that the people who I'm talking to about investing, they're not really interested in learning about investing. They just want someone to do it for them. And my suspicion is, at this moment, as I'm talking about investing, many of you are like these people here. You're probably watching Netflix. I'm not sure about that, but balancing. So Elisa has another one. Balancing our investments so that they will grow most effectively. Again, that's an overall plan that these investment strategies will help you do. But here's what I want you to think about for the perfect investment. So at this point, most of you, if you've done what I've asked you to do, if you've completed the assignments, you did a little research to find out where you would be working. If you get your dream job when you graduate, you have a company in mind. This is the company, this is the position, and that comes with a certain salary. So that's great. I'm going to ask you today to make an assumption, all of us together, that we all got that perfect job and we're making $100,000 a year at that job. And let's say that the company is, let's say, Shell Oil. And we each decided that, that's where we wanted to work. We got the job. We're making $100,000 working at Shell. And so the perfect investment is we go to work at Shell and we find out that they have a 401k plan. And guess what that 401k plan has in addition to just a place to save money for retirement? The 401k plan has this feature, a couple of features that make it very special. And it's the reason I call it the perfect investment. And that's what I want you to think about for a minute, because in the next couple of weeks, one of your assignments is going to be to implement this perfect investment in your financial plan, to show yourself what a difference that will make over time if you actually take advantage of the perfect investment. And it's Super easy to do. So does anybody know, now that I kind of given a little clue, what the perfect investment is, what it looks like, what it's made up of? I'll count to three. One, two, three. So in the Zoom room, no one's answering. Hopefully, when I finish this broadcast, I'll go check Facebook and YouTube, and I'll have some great comments. But what do you think the perfect investment is, now that you know it has something to do with working at Shell, and it has something to do with the 401k plan that comes with that job? So here's what it is. When you go to work, wherever you go to work, if you get that job at a big company, chances are they're going to have a 401k plan. And that 401k plan typically, almost always, is going to have a feature called a company match. So again, in our scenario, we're pretending that you got the job at Shell and you're making $100,000. And now let's assume that the company match at Shell, at this imaginary job, is 6%. So now think about it. Whatever job you got, whatever research you did to discover how much you would get paid at whatever company you went to work for, when you take that assumption, this week I want you to do a little more research, and I want you to find out, how much does that company, do they have a 401k plan? Chances are they do. And if they do, what is the company match? Because that is about that's what I'm going to unpack for the next couple of minutes. And that is what I consider the perfect investment. Many people fail to take advantage of the perfect investment. Over my career as a financial planner, I can't tell you how many times, how many people, how many families I met with who were trying to get their finances set up and working well, and they were missing out on this incredible opportunity, the perfect investment, the company match. So let's walk through how it works real quick. You're working at Shell, you're making 100 grand, company match is 6%. So what do you think Shell is willing to contribute to your 401k plan in that scenario? If you're earning $100,000 a year and the company match is 6%, somebody answer that question for me. What amount of dollars is Shell committed to pay you in your 401k plan? Yes, 6 grand. Yes, it's 6 grand. Now, the next question is, if you work at Shell, you make 100 grand and they have a 401k that matches 6%, what do you have to do to get the $6,000? What is your job? How do you get that 6% match? What do you have to do? If you're making $100,000 and you're working for Shell and you want to get that 6% match, that $6,000 that they're willing to contribute to your 401k, what do you have to do? Yeah, Karen, you have to give or contribute 6% of your salary over the year to your 401k plan, which means that every time when you sign up, when you start working for Shell, you're going to have a meeting with HR, and one of the first things you're going to do is fill out the forms for the benefits. And one of those benefits is the 401k plan, and they're going to ask you, do you want to participate in our 401k plan? And you're going to say what? Hopefully, yes. That's like a no-brainer. But that's not it. It doesn't stop there. The next thing you have to say is, if you're going to participate in their 401k plan, they're going to want to know, how much can we deduct from your paycheck? And that's where you have to do a little thinking. And that's where the perfect investment comes in. So Alyssa says, I have to put in at least 6% into the 401k, or $6,000 to get the company match. That is exactly right. And that's where a lot of people fail. They think, I don't, I need to save my money. I need it to pay bills, this, that, and the other thing. I can't afford to put that much money into my 401k. And if they don't put in this scenario, if they don't put 6 grand into their 401k, how much is that? If you get paid every other week, how much would $6,000 be from each of your paychecks if you get paid every 2 weeks? Think about that for a minute. Just think about 6 grand. There's 12 months in a year. And so how much is that per month? What is that? That's $500 a month, right? Am I doing that right? 6 grand divided by 2. Well, there's 12 months in the year. So yeah, $500 a month or $250 a paycheck. Thank you, Karen. Thank you, Alyssa. I appreciate that. I appreciate your contribution and your participation. It makes me feel like I'm not doing this all by myself, like somebody's listening. So yeah, that's pretty simple, right? If you know you're going to get a paycheck and every month $500 is coming out of your paycheck, you are going to meet that company match of 6%, which is awesome. That is the perfect investment. But that's not all. What happens when you take that $6,000 over a year and you put it into your 401k? You've already answered this, by the way. You put in 6 grand, and what does the company do? You know the answer. We've already talked about it. That's why it's the perfect investment. They match $6,000. So now you've put $6,000 into your 401k. And they match it. Yeah, Jessica, they match it. So now, how much money do you have in your 401k? This is the perfect investment. How much money do you have in your 401k? Yeah, Alyssa, 12 grand. Jessica, 12 grand. That is why this is the perfect investment, because you put in 6 grand and they matched it and you just doubled your money. And you haven't even talked about or thought about investing. So a 401k is a type of account. And question, are there any tax benefits breaks for those 401k contributions? That's a great question. And like I said before, that's not all. Not only does this perfect investment, the 401k with the company match, double your investment. I mean, that's basically what it does. If you put in the match, the company matches it, and now you have twice as much money as you put in. In addition to that, yes, there's a tax benefit for a 401k plan. When you put that $6,000 in this scenario, you're working for Shell, you're making 100 grand a year, company matches 6,000, you contribute 6,000, and that 6,000 that you contribute allows you to have a $6,000 tax deduction for that year, which means when you get ready to pay taxes, the taxes that you pay, instead of paying taxes on $100,000, how much do you have to pay taxes on? If you contributed $6,000 to your 401k, and if that $6,000 is tax deductible, then how much do you pay? On what amount do you pay income taxes in that scenario? Sahil, you should be able to answer that. Elisa, that's correct. Ruby, that's correct. Sahil, you got it. Does that make sense? You asked about another benefit, a tax benefit, and that is the tax benefit. You put the money in and you get to take a deduction. You're welcome. Thank you for asking. So that's the perfect investment. Now, there's much more to it. And in your next couple of weeks, you're going to do some homework assignments where you're going to learn more and more excuse me, about tax advantaged investing. In your financial plan, I'm going to require you to do what we call tax allocation in your financial plan, which means you're going to have to, in your overall financial plan, in your savings plan, you're going to have to designate the savings dollars that you're putting into your financial plan as tax deductible, taxable, and tax-free. That's 3 different categories, and you're going to see that in your financial plan. But for today, in talking about the perfect investment, we've already unpacked the tax-deductible type of account. Now, 401k, that's the paragraph number in the IRS code. That's all 401k is a paragraph code. But that paragraph, 401k, has all the rules, boundaries, and limitations related to a tax-deferred type of account, a 401k. Now, some people think a 401k is an investment. Think about that for a second. Is a 401k an investment? Is a Roth IRA an investment? Or a tax-deductible IRA? We're going to talk about all of that next week when we get into types of accounts. But that's what I want you just to plant the seed today before we get into these 4 investment strategies. I want you to understand the distinction between a type of account like a 401k and a taxable account, which means it doesn't have any tax benefits. Those are types of accounts. And that's different than an investment. I'm going to teach you about investments, but most people get confused. They think 401k, that's an investment. You could be doing investing in your 401k account. You should be. I'm going to teach you how. But the investments in that account, those investments that are in that account are the investments. The 401k is simply a type of account. So just understand that distinction, and it will help you later on, I promise. Okay, any questions about the perfect investment? Remember, in this course, there are 3 laws to personal finance. The first law is the law of spending and saving. Spend less than you earn so you can save more for what matters most. That's the first law of personal finance, and a lot of people miss that one. The second law of personal finance is the law of tax-advantaged investing. The IRS makes the law. Your job is to take advantage of it. And so when you understand the perfect investment, you start to begin to recognize why the law of tax-advantaged investing really works, especially in terms of the perfect investment where you get a match. But there's much more to it, and I'm going to teach you that in the next couple of weeks as well. The third law of personal finance, by the way, is the law of purpose and commitment. So I'm asking you to commit to not just learn this stuff, but to actually do it in your life. And the perfect investment is probably the most, specific thing that I'm going to ask you to do. There are 2 specific things I ask you to do every semester. Excuse me. The first one is, if you haven't already started your savings, your emergency fund, like if you don't have $1,000 in a bank or credit union, you need to be doing that. And if you already have 500 saved, you need to get it to 1,000. If you already have 1,000, you should get that to 2,500. That should be a concrete, specific, measurable thing you do as a result of taking this course. That's number 1. Number 2 is you need to prepare for, be ready for, absolutely know what you're going to do day 1 when you get that job. And the perfect investment is it. You need to know that you're going to sign up for that 401k. You're going to figure out how much does the company match, and you're going to make absolutely sure that you put in at least what the company matches. Because if you don't, you're missing the opportunity to take advantage of the perfect investment. So those are 2 things, the emergency fund and the perfect investment, that every student who goes through this course needs to know that it's something you can do that can make a big difference in your financial life. And the next thing I'm going to ask you to do is understand these 4 investment strategies. So this week you're going to learn about asset classes. And when we talk about diversification, it's important to understand asset classes. Anybody know what an asset class is? going to just tell you what some of them are, but you're going to have to do a little research just to wrap your head around different asset classes. So stocks, bonds, cash, those are asset classes. When we say stocks, though, there's so many different kinds of stocks. Let me just show you. This is a watch list. Let's see, what's the market doing. The market was up almost 600 points today. When I say the market, I'm usually talking about this one right here. This is the S&P 500. That's a chart, I think a 6-month chart. So if we talk about investments, we need to understand some things. One is asset classes, because when we talk about diversification, I'm going to talk about Enron, the company Enron. If you haven't heard of Enron, or you're not sure what happened, I think it was back in 2000, then you need to do a little research. Maybe watch a movie or two about Enron. But people who invested in Enron, that's kind of the story I'm going to tell you about diversification. But before we do that, we need to just understand a little bit about asset allocation, which again, or asset classes rather. So this is just a chart for a specific investment. It happens to be my favorite investment vehicle of all time. If I could only invest in one thing, it would be the SPY. The SPY is an ETF. It's an exchange traded fund. That's different than a mutual fund. You're going to have to learn a little bit about what's a mutual fund, what's an exchange traded fund. You don't have to be an expert, but I'm going to teach you what these different types of investments are. An ETF, a mutual fund, an index fund, an individual stock. All of those could be equities. So the reason I like SPY, it's my favorite investment of all time, is because it represents the S&P 500. What do you think the S&P 500 is? You're going to learn that this week. You need to understand what an asset class is. And to start with, let's talk about a company stock, an equity. So you can't really, you can't understand investing very well if you don't at least know what a company stock is. And so these, the stocks, the company stocks that are in the S&P 500, the Standard & Poor's 500, those are the 500 largest companies in the world, and certainly the largest in the United States. So there are 500 of them, and they're in the S&P 500. And so if you wanted to buy all of those stocks, you could buy one ETF, one exchange traded fund, the SPY. And with that investment today, that thing's trading for, what is it trading for? $367. Uh-oh. New homes in Conroe. I'm getting my ad. You can tell I'm not a premium subscriber to this app. But this is the SPY. It represents the S&P 500, which are the large companies, large U.S. companies. So that's an asset class, large U.S. companies. And again, if I could invest in only one thing, it would be the SPY, because Coca-Cola, the largest companies in the United States are in the SPY, the Standard & Poor's. So let me ask you this. If you were going to invest in a company, would you rather invest, let's say you had $1,000 or $100,000, would you rather invest in one company like Enron? Enron, by the way, was a company that their stock price just kept going up and up and up. And I worked for a couple of people that worked for Enron. I was a financial advisor, financial planner. One of those people's name was Bill. And Bill had over $1 million in his 401k plan. And he was ready to retire. And Enron started to have a lot of trouble. The trouble they had was self-imposed. They were cheating on their books. They were making it look like they were making tons and tons of money, and everybody was buying their stock because the earnings reports were so good, so incredible, that everybody just kept buying the stock, and the price kept going up and up and up. And Bill worked there. He was a lower level manager, but he'd saved a lot of money by buying Enron stock. He bought Enron stock in his 401k plan. So instead of putting in his 401k, he had some choices, and he could have diversified. He could have put all of his retirement money, those contributions and the company match, he could have put it into something like this ETF, where he would have had diversification. But instead, he wanted to see his 401k go up and up and up the way Enron stock was. So he put all of his money in Enron stock. And when the company imploded, first thing that happened is the company leaders started telling all of the employees, look, there's never been a better time to invest in Enron than now. So you should double down. And Bill doubled down. He put even more money in Enron stock. And before long, Enron stock was trading for pennies. Bill lost everything. And he ended up dying of a heart attack because of stress, and he lost everything. And his widow, I knew her pretty well. She had to live on nothing. She had to get a job. She'd never worked before in her life. This was just one person that I knew. There was another lady that I worked for. She was a middle manager. She worked in Enron. She made really good money. But instead of buying all that Enron stock, she did diversify. And she had her 401k in something way more like the SPY. And so what happened with her was she ended up actually doing quite well. She lost her job at Enron, but she had a pretty good chunk of change that she'd saved in her 401k. And the reason she did well and he did not is because she was diversified. She was diversified. So you're going to learn about different asset classes like large U.S. stocks. And you're going to learn about small cap stocks. And you're not going to be an expert. I don't expect you to be an expert, but I want you to be curious. I want you to be curious enough to understand that different asset classes are different. So there's a difference between a company stock and a bond. And again, you don't have to be an expert, but you should understand that there are differences and that those investment vehicles, those types of investments they're going to do differently in different market conditions. Speaking of market conditions, look at that. If I told you that's my favorite investment of all time, and you're looking at that 6-month chart, you got to be wondering, man, why would you want to invest in something that's gone down so much? I mean, look at a 1-year chart. The S&P 500 has had a nasty, nasty downtrend. And if you look at the maximum, look at over a long time, though, it's gone up, up, up. But man, in the last year, it's just taken a nosedive. But that's how it works. And that's why these strategies are going to be very, very important for you. So let's talk about them. So the first one is simple. It's diversification. Don't put all your eggs in one basket. That's the first investment strategy designed to help you maximize returns and minimize risk. Next is asset allocation. There's no more important investment strategy. Let me say it this way. The single most important determinant of your portfolio's returns is asset allocation. So it's, again, a reason why you need to understand what different asset classes are. And you're going to learn that this week in your homework assignment. And you're going to need to understand asset classes to be able to recognize the benefit or the value or even how it works to have the right asset allocation. So I like to say, when we talk about diversification, let me tell you this story real quick. This is a story my friend David taught me. We were both investment advisors. He had more experience than I did at the time, and he helped me learn how to tell stories that helped people understand risk and investing. And so this is a story. David told me this story, and Taylor, my friend, did the illustration, which I think is great. It shows these two guys are in two different elevators. On the right side of the page, there's an elevator with lots of cables. Now, in that elevator, this is representing an investment, and the investment is a mutual fund. This is how David taught me. That's not an exchange traded fund, but it could be. The thing is, with a mutual fund, you have a manager, okay? When you buy a mutual fund, you get the same diversification that you would get in that SPY ETF, except the difference is you have a mutual fund manager, and their job is to inspect those cables, those companies, each of the companies in that fund. They inspect them and they review them, and they're always doing risk analysis. And sometimes when they see a cable, a company that's weak or frayed, they will take that company out of their mutual fund and replace it with a different company. And you pay a fee to that manager who's selecting these investments in the mutual fund. And that's what that elevator on the right represents, is a mutual fund that has a manager whose job is to always be inspecting and reviewing and doing risk management on all of the companies that are in the fund. And you pay a fee for that. Which is, again, one of the reasons why I like SPY. There's no fee. The fee is 10 basis points. It's amazing. It's awesome. It's an exchange traded fund, very different than a mutual fund. We'll get into that later. But for now, just to know, diversification on the one side, this diversified investment is better, superior. It's a much better way to manage risk than the elevator on the left, which would represent Enron. Because when that elevator, that elevator has one cable, that investment has one cable, and it's Enron. And when that cable frays and falls apart, your entire account, your entire net worth, if you're all invested in that one company, goes foof, Barbados, it's gone. So that's what that illustration is for, diversification. And then we have asset allocation, and I think of it like balancing a tire. So if you think about your portfolio, and if you have a portfolio, think of like a pie, a circle, okay? If you have a circle, I could draw a circle. I guess let me do that. Let me open this up and draw a circle. So here we are, if I can get this working. So let's just say I'm going to try to draw a circle here. And that's your portfolio. And let's just say it's got 4 quadrants. And let's say we put SPY here. SPY would be the S&P 500, large cap stocks. And this is exactly what you're going to do on day one when you get that job and you sign up for your 401k. They're going to then ask you, you want to be in the 401k? You're going to say yes. And then they're going to ask, how much do you want to contribute? And you know the answer, I hope. If you don't, rewind the tape and learn the answer. How much are you going to contribute to your 401k? But then the next question they're going to ask is, where do you want to allocate that contribution? And that's where this comes in really handy. So this is just a circle. It's your portfolio. It's your 401k, your Roth, whatever it is. This is where you're going to allocate those assets. Asset allocation is the single most important determinant of your portfolio's returns. So we got SPY. That's large cap. And then let's say we do MDY. Well, that's mid cap. What do you think mid cap is? If SPY is large cap, what do you think mid cap is? It's middle size companies, and they do differently than large cap companies do. And so you'll learn about that. But just for now, I want you to understand this is a circle and this is your portfolio. And let's say here we put bonds. Now you don't know much about bonds, but let me just tell you, bonds typically do differently than large cap stocks. And then we could say, let's just say international. So international would be not U.S. companies. Let's say international stocks. And there's lots of ways to invest in international stocks. Just like SPY is an ETF, there is also an ETF with a different ticker for each of these other asset classes. But the point is, now we have 25% in each of these different asset classes, okay? And they're very different. They respond differently to different parts of the business cycle or the economy. So you saw what's happening to the SPY this year. It's going down. Well, typically what you would see is bonds would be going up. But because the Fed is raising interest rates, and interest rates, bonds are inversely, and this is way more information than you need right now, but it's helpful to know, and I need to make sure I say it, that bonds, the value of bonds goes up when interest rates go down. So what do you think happens to the value of a bond when interest rates go up? The value of the bonds go down. So unusually, and this year in 2022, we've seen large cap stocks go down. Everything's gone down, including bonds, because interest rates are going up. That's usually not how it happens. But anyway, let's say this is 25% in each of these four asset classes. I always like to talk about asset allocation, the number one most important determinant of your portfolio's returns. It's really important to have good asset allocation. And if you have good asset allocation, you automatically have diversification, right? That makes sense, because if you have good asset allocation, you're not in one company or one sector. That's why asset allocation is the single most important determinant. But it's like balancing a tire. So what happens over time? You start out with this balanced portfolio. You've heard the word balanced portfolio. And it's balanced in the way that you select to balance it. And that's what this is. It's a balanced portfolio. So in this balanced portfolio, over time, what happens is one of these quadrants gets out of whack. It gets out of balance. And we'll talk about portfolio rebalancing. That's the fourth investment strategy. But to start out, I just wanted to show you a balanced portfolio, good asset allocation. It runs very smoothly. That's why I like to think of a balanced tire. If you've ever balanced a tire, you know that you have to add weights to balance the tire so that it's smooth. You don't want a tire that's out of round. So asset allocation is like that. Your portfolio runs very smoothly if you have good asset allocation. Next, we have dollar cost averaging. And I see we're going to run out of time. So I think what I might do is I'm going to post a previous lecture, so you're welcome to watch if you want to get the whole lecture. You can watch, but I'm going to talk about Farmer Joe. I'm going to save that for next week, and I'm going to teach you about dollar cost averaging, which is the most powerful investment strategy for younger people who have a long time horizon. Dollar cost averaging is I believe the most powerful investment strategy to help you maximize returns and minimize risk. And so I'm going to tell you a story about Farmer Joe, which again, it's in the video that I'll post. It's already posted in Money Study Group. So you can watch that and see that story. You can fast forward to that story if you watched the Zoom meeting up to this point, where I leave off with dollar cost averaging. And I'll pick up with that next week, and I'll tell the story of Farmer Joe. But we covered a lot today. We covered, did a little review on the insurance and how to add home and auto insurance to your plan. So if you missed that, go back and watch it. If you came late to the Zoom meeting, whether you're on Facebook or YouTube or you're here, there's not that many students in the meeting here, so I'll answer your question in a minute, Ruby. Give me just a second. So go back and make sure you understand what's required in the assignment for adding your home and auto, because it's going to show up again on your capstone. So if you missed that, go back and watch it. That's what we talked about at the beginning of today's lecture. And then we talked about the perfect investment. Make sure you know, that's an important part of today's lecture and every semester. The perfect investment. You should understand that inside out, forward, backwards, upside down. the perfect investment is really important, and it's super easy for you to use to make a big difference in your financial future. So make sure you understand the perfect investment. And then we talked about the 4 investment strategies that are designed to maximize returns and minimize risk. But we only got to diversification and asset allocation. Now, this week, you're going to learn by doing a little homework about asset classes. And that's going to really make next week's story about Farmer Joe and dollar cost averaging make more sense. So please do your homework and understand as much as you can about asset classes. Now, before I let you go, it's the end of today's lecture, and I'm going to ask you to do something else. In this week's assignment, I'm going to ask you, your class collaboration is to show me that you made this one change to your financial plan. So I'm just going to ask you to trust me on this, but I want you to become 10 years older. Okay, so whatever your birthday is today, if you were born in 1995, I want you to make yourself 10 years older, which means you got to change your birthday to 1985. So whatever your birthday is, add 10 years, and that's your class collaboration. That's what I'm looking for in your assignment, a screenshot that shows you and your financial plan 10 years older. And the reason I'm asking you to do that is because we're going to go back and rebuild your plan so that you can see what happens when you contribute to your 401k and you take advantage of the perfect investment. So I'm setting up your financial plan so that you can see what it might look like 10 years into the future if you actually were doing the things that I'm teaching you to do. So Ruby asked a question, can you continue to use the Bayrock planning portal after you finish the course? It is a great tool. Thank you, Ruby. It is the premium financial planning tool that I use with my wealth management clients and for myself. It's a great tool. It took a long time to develop it and build it, and it's a great tool. And the answer is, Ruby, yes. Because you participated in this course, for the students who want to continue your journey in financial planning, you will have access to the Bayrock portal. You'll also have access to continued education just to learn and extend your knowledge about these financial planning principles. So thanks for asking. So yes, you will have it, and we'll talk about that more at the end of the semester. So if you're watching on YouTube or Facebook and maybe you're not in this semester's course, but maybe you were part of a previous course, you have access to it as well. And if you're not sure how to do that, just shoot me a message. The best way to reach me is through LinkedIn. If you're in the course, you know how to reach me by email or text message. So I'm going to end there, but I'm going to just say thanks for today, for you being here. I'm sorry my voice is so jacked up and I'm coughing half the time, but hopefully I'll be better next week, and we will continue with Farmer Joe, and I will tell you the story about how Farmer Joe used this strategy, dollar cost averaging, to maximize his returns in buying and selling cows. And if you understand asset classes by next week, if you understand just a little bit more about the different asset classes, it'll make a ton of sense to you how dollar cost averaging is a powerful investment strategy that is designed specifically to help you maximize returns and minimize risk. And it works especially well when we're in a market like we are in now, where we see there's so much volatility. The market's going up and down, and I'm going to teach you how to make money investing in these kinds of markets, especially if you're young and you have a long time horizon. I promise you don't want to miss the story about Farmer Joe and dollar cost averaging. So I will see you next. So I have a question, and I'm going to go and give me a second. I'm going to go and end the live stream, and then I will come back and answer your questions. So if you're in the Zoom meeting and you want to ask some questions, feel free to do that. If you're watching on Facebook or YouTube, I will see your questions and I will answer those. but I'll be right back. I'm going to go over here to the live stream, and I'm going to finish. So if you're watching on Facebook or YouTube, this is me saying goodbye. I'll see you next week. And